Yo, how you guys doing? This video is going to be solely on time frames, the best time frames for entries, the best time frames for understanding market structure, and what time frames you need to use depending on what trader you are. So let's get straight into it. As you can see, this is EUR USD, EUSD, and we're on the weekly time frame. From my experience, I like to trade. Sorry, from my experience, I like to use the higher time frames to understand where the market is going in the long run. The higher time frames will basically tell you where the market is going in the long run and what the market and what the price actually wants to do. So what you do is it's called top-down analysis. You start with your weekly. You can understand on your weekly that price is moving up, as you can clearly see here. And what I like to do is draw my resistance and try and draw my major resistance and major supports on the higher time frame. By doing this, we know that on a higher time frame, where the prices actually respect these areas of resistance, we know it's going to respect it in the future. As the higher the time frame, the more respectable the price is going to be of this area. So for example, here we can see that we have got a support here, a weekly support. And we know for what, 1, 2, 3, 4, 5, 6, 7 weeks, price has not been able to break this area. So we know that we can draw this along and actually use this as a support for the future, because the weekly charts are telling us that this price cannot break this area, therefore being stronger. Now, what we next want to do is break it down to the day. Try and find the day support and resistance. Here we can see here again, look, bang, bang, it is not broken through. This is a strong area of support. You want to find your resistance. We can maybe say here, resistance here, price has not been broken again, and price is respecting it again, as we've got this wick here. So the idea is that the higher time frames are used to find your strong resistance and support levels. So now we have a zone that we can trade in. This is what I like to do on the week and the daily. And breaking it down even further, going to the 4 hour. The lower time frames we can use for maybe the 4 hour resistance, finding a 4 hour resistance, or finding a 2 hour resistance, let's say. These won't be as strong as the week or daily areas of value, but we can use them to say, let's say if they move to these areas, we can get an idea of how the price reacts to these areas, whether it's going to break them or whether it's going to respect them. So the idea of the time frames is to use the higher time frames to understand where the market is going, to understand market structure, and depending on what trader you are, will be depending on what time frame you actually enter on. So a lot of people don't know what time frames they need to look at to enter, and or what's the best time frames to enter, and that depends solely on what sort of trader you are. If you're an intraday trader, you don't want to be looking at the 5 minutes to understand where the market's going. That's silly. It's not going to give you. It's not going to tell you accurately where it's going. It's noisy. It's all over the place. You've got tons of support and resistance. So you've got resistance and support here, resistance here, resistance here, but it breaks it. The lower the time frame areas of values are, the less respectable they're going to be. Price is easily going to push through them. They're not going to respect them at all. So some people here might have drawn a resistance here because, okay, we've got support there and we've got resistance here. So people might think it's going to respect it, push down and go lower. But no, as you can see here, it just breaks straight through. So going back to what sort of trader you are and what time frames are best for you. If you're an intraday trader, you want to be looking at the bigger picture. You want to go to the day, the week to find out where the market's going. And then to find the best setups, you want to break it down to the 2 hour or to the 1 hour. So here we can see, knowing market structure, we've pushed up, respected this resistance, pushed down and created a lower high. Now, the lower time frames are used, and I use them personally because you are able to get these, what people call them, sniper entries. So we understand as an intraday trader that price on the day and weekly is pushing up, and then on the hour to 2 hourly we can see the structure a lot clearer. We can see where price is moving and where these new zones are. But of course here, where we've drawn our 4 hour resistance, we can't say it's going to completely respect this, but we can use it as a level of an area of value that we can get an idea of where, if it does go to here, and how, depending how price reacts to it, that's when we make our decisions. But with the sniper entries and going down to the lower time frames, you can get a better idea of where to enter. Okay, so market has made a lower high, it's pushed up, you've missed this move. Okay, let's say you've missed this move, so let's say here you want to enter. You want to wait for market to create a lower high again, because we know market is going up. We're looking for buys. So as a intraday trader, let's say you're trading within the day, you're closing your trades within 24 hours within the next few days. We see that price has gone up and we're now creating a lower high. Using the lower time frames, you can scale in and find the best place to enter your trade. You can look for these lower highs as if you were looking at the higher time frame. You can clearly see here that you wouldn't know where to enter. You wouldn't know where to put your stop loss, and you could be entering too early. So the idea of breaking it down from the higher time frame to the lower time frame is to get an idea and the best place to enter. So if you're a scalper, you want to be looking at the hour to understand market structure and then entering within the 5 minutes. And if you're a day trader, you want to be looking at, let's say, the day time frame to understand market structure, to find the trends, and then breaking it down using the 2-4 hours, and then using the 15 minutes to really finalize your entry points, find the best point to enter with the smallest stop loss. So I hope this has cleared it up for you guys. I hope it's made sense. If you have any questions, do feel free to DM, feel free to put the comments in the comments section. But the overall idea of timeframes is that you use the higher timeframes to understand market structure, to understand where the market is going, where the price wants to move. And then by, depending on what trader you are, scaling down to find your entry points. So if I was to say what's the best time frames to use, I'd say the day to find a structure, and then if you're an intraday trader, then scale down to the 2-4 hour, even 1 hour to find where the market is moving within the day, and then go to the 15 minutes to find your final entry point, using the lower time frames to enter at the best possible places. The lower the time frame, the less accurate the market is going to be. It's not going to tell you exactly where it's going in the long run. It's just going to tell you what the market is doing there and then. It's going to be a lot more noisier. I hope this has cleared it up for you guys. Look forward to seeing you guys soon.